Well, today we have a late day risk on rally. It's causing most volatility in most asset classes to drop. But before we get into that, let's talk about the common narrative of what stands out from the themes of last week that are filtering into this week. And the first is skew. S&P implied skew did steepen and it continues to steepen, but remember, last week it was at the second percentile, right now the 13th percentile, so it's still very, very cheap in the scheme of things. Secondly, term structure flattened last week and it continues to flatten today. That's something we haven't seen in a long while. It went from 6% down to 4.5% last week, but again, term structure still is fairly steep. Implied correlations continue to rise, and that's the top 50 stocks, implied correlations to the indexes. But remember, it's going from a 5-year low. So this might be a dead cat bounce. We don't know. But last week, implied correlations did drop, or they rose, but they rose from a 5-year low. Lastly, correlations between equities and other assets continued to dwindle lower last week, except for the commodities market. So why did I bring all that up? I did because it's very important to recognize that there's a common thread going on right now. It seems like the issues concerning the U.S. and our debt issues are on the back burner, and it's causing volatilities to contract. It's causing skew and term structure to do things that maybe shouldn't be going on, but it's because right now we're in a safe zone. All eyes right now are basically on earnings, and earnings have been very, very good by and large. 75% have beaten earnings per share, 66% have beaten on the revenue side, so it's stunning to think. Now today's Tuesday, we have VIX down 3.75%. Do keep in mind that yesterday VIX was up quite a bit, so just backtracking just a little bit on this risk on rally. Euro FX vol down about 0.5 point, 1 month at the money implied, largely due to euro and the yen, which is giving back a lot of volatility that it's been up last week. Gold also down gold's down a stunning 1.5 point, 1 month at the money implied volatility, but there again, it's snapping back from where it was last week. So being down 1.5 points might not be too big of a deal. Lastly, oil seems to be the outlier. 1 month at the money implied up about 0.75 point. I think with this risk on rally, oil traders not sure of what to make of the next move. It's getting pretty frothy in the oil market, so people are grabbing for risk protection right now. I'm Larry Shover, CIO of SFG Alternatives, reporting to you from the CME Group in Chicago.